Yes. Good evening, everyone. I am CA Maheshindani, the moderator of this webinar. I am delighted to welcome you all in the webinar being organized by the CP Committee of ICI. It is my pleasure to be moderator of the webinar on the Territorial Nexus in Taxation and Evolutionary Perspective and Direct Tax Vivad se Vishwas Law and Practical Perspective. In a short while, we will start this webinar. First, I would like to apprise you about the CP committee. What CP committee is of the ICI. The profession of chartered accountancy is growing leaps and bounds, and its phenomenal growth has brought the profession at a forefront. Today, our profession has acquired an indispensable position in the business and economy. ICI continuously aims at developing knowledge edge so that the members stand out to the expectations of the society. To achieve this objective, the CPE Committee of ICI has continuously striving for the perfection, integrity, and knowledge, which make the word chartered accountant synonymous with excellence in service. In this direction, CPE Committee has always been proactive to the emerging needs of its members, enabling them to acquire contemporary knowledge and skills to face the challenges effectively by organizing the CPE programs and providing adequate opportunities. As rightly said, the CP committee has arranged the various webinars from time to time, and it's really helpful for all the members. Now, as coming to this program for this evening is as follows. We have two sessions, 1 hour of each, and the topics are Territorial Nexus in Taxation and Evolutionary Perspective, for which we have with us CA Karan Sukramani sir, and Direct Tax Vivad se Vishwas Law and Practical Perspective, for which the Prashant sir we have with us. Our eminent speakers will talk about the above mentioned two emerging areas of the professional interest. Now, moving ahead, I will now just introduce our today's speaker, and then I will hand over the session to the speaker. CA Karan Sukramani sir. He is a CA with around 10 years of experience in corporate and international tax, transfer pricing, tax litigation, and regulatory matters, and has also assisted some of the leading domestic and multinational corporates, startups, high net worth individuals on tax litigation, structuring unilateral and bilateral APA, and advanced ruling, etc. He has done extensive research in tax and regulatory issues. He also writes columns relating to the recent developments in international taxation, including BEPS and digital economy, for some of the most popular journals and publications issued by professional forums, including ICI, IFA India, and the regional professional associations. He has also addressed and presented papers at various seminars on various topics relating to tax, regulatory, and topics of general public importance. Surely this session will be of great helpful to us. So now over to you, Karan sir. Please share your knowledge with all of us.
Thank you, Maheshji. Thank you for the opportunity to address the participants and inviting me to deliver a session on one of the interesting topic. So good evening, everyone. So the topic that we are going to discuss today, as you can see on the screen, is the territorial nexus in taxation and evolutionary perspective. Now, why I chose this topic is because over a period of time, like the act was enacted way back in 1961. And at that point of time, the definition of income as well as the concept of nexus, both of them, they have evolved. And if you look back now, because we are going to see anytime soon the new income tax law and what it has to offer so far as the definition of income is concerned, there's also the concept of nexus is concerned. It is important to look back and see from where we started, where we have reached now, what all kinds of sort of significant changes or the milestones that we have come across, and how the concept or this subject has evolved. So while the topic for today's discussion is not the income, our discussion would be largely around the concept of nexus. So I've divided this presentation into 5 parts. The first one is about initially we'll discuss what do we mean by the term nexus and the theory around nexus, what are the views of the scholars, judiciary, and the legal dictionary in general, how it defines the concept of nexus. Then how the concept of nexus has evolved over a period of time, and more particularly in line with the Income Tax Act. Given the time constraint, while the concept of nexus is applicable not only to the taxation law, it also applies to many other laws. We restrict our discussion only to the concept of tax, and that too particularly the Indian Income Tax Act. Then we'll also see some of the landmark judgments which have examined the concept of nexus in little detail and have also sort of seen this concept with the eyes of constitution. And of course, the most important aspect of this presentation, the recent developments, which is BEPS Action Plan 1, BEPS Action Plan, BEPS Action Plans in general, and BEPS 2.0, which is now Pillar 1 and Pillar 2 concept that they have brought in. So we'll touch upon those aspects as well for the Nexus. So see, the concept, before we start on the Nexus, let us also understand that there are two concepts which are very important so far as the taxation laws are concerned, particularly the income tax. One is the income and another is the nexus. Lord Denning, in one of the judgment, has mentioned that if you can define income, then it would be a pearl of great price, meaning thereby it is impossible to define the income. Yet in India, we have the definition under the statute definition of income. But yes, again, it is an inclusive definition, meaning thereby over a period of time, we have expanded the reach and the definition of the income, and it has sort of tried to cover almost everything. So also, the concept of nexus cannot be defined as such. So to say, it is impossible to define the concept of nexus because with the changing dynamics, with the period of time, the business models change, the way of working, the environment, the policy, the regulation, everything changes. With that change, you cannot restrict yourself to a particular ideology or a particular set of rules or the particular nexus concept that was developed way back 100 years back, even till today. So the concept of nexus cannot be defined precisely. Any attempt to define the concept of nexus would be a futile exercise because different people will have different views. And when it comes to India or any particular country, then probably the taxation of subjects and objects would be relatively easy because you have a subject within that territory. You also have got an object within that territory. So it becomes very easy. The moment you step out from your own jurisdiction and go to a cross-border scenario, in that case, the concept of nexus becomes very important, and there cannot be one common definition or one common concept when it comes to taxing the objects when two countries are involved or more than two countries are involved, because each country will again have, it will fight for its fair share of taxes. Yeah. So what is the simple or a dictionary meaning of nexus? So the term nexus, I just minimize this. Yeah. The term nexus refers to the connection or a link between things, person, event, especially one that is part of a chain of causation. Now, this concept of nexus is not restricted only to the tax matter as I discussed. It may be relevant from a jurisdiction point of view, from a taxation point of view, from a regulatory or an enforcement point of view, in case there is a conflict of laws or in case of a causation. Jurisdiction. Take a very simple example. There's an assessee or a company which is incorporated, let's say in the city of Ahmedabad in the state of Gujarat. The income tax authority carry out the search and survey operations. Now that company has a registered office in Ahmedabad, Gujarat, but it has got a corporate office in Bombay. It has got factory in Orissa. It has got branches across different states of India or outside India as well. Now the question that arises is if the assessee wants to challenge the validity of the search and survey operations by way of a writ petition, which court it is supposed to approach? It is supposed to approach the court which is Gujarat High Court. Now, why is this so? This is because of the constitutional or the concept of nexus enshrined in the constitution, which says that it is the state which has to administer the laws relating to that state. And for the courts also, which is again a creature of constitution, this right has been divided based on the object and subject within that jurisdiction. Take the example of an income tax. You can levy the income tax on a resident on his worldwide income. But the moment it comes to non-resident, you have to be careful. You have to design your laws to ensure that the law doesn't become extraterritorial, or the legislation does not become extraterritorial legislation. Same is the case with regulatory compliance. The moment you legislate, it is also important that you ensure that what you have legislated can be enforced as well. Conflict of law. In case two nations are taxing a same transaction, the conflict arises because the double taxation tax takes place. And that's where we have the concept of tax treaty. And in the tax treaty, there are a variety of nexus that we see. Take an example of an immovable property. If a person, Mr. A, who is resident in India, is having an immovable property in France, then by virtue of his residence in India, his worldwide income becomes taxable. So whatever income or the rent he earns, it is taxable in India. On the other side, in France, because he has got an immovable property in France, the France will say that, okay, the object is in my state, so therefore I have got a territorial jurisdiction to levy the tax on the rent income. So there comes the double taxation. So what we have done, we have entered into a treaty with the foreign country, and that's how we resolve the double taxation, by through credit or exemption method, or by giving the primary right to the source jurisdiction to tax a particular transaction. Causation, even in the tort law, non-revenue law, even establishing a nexus becomes important, because take an example which I've mentioned, defendant's action in the plaintiff's harm, that is essential to prove the causation and liability. So this is about a general meaning of the nexus. And often the question arises, and which is discussed among the scholars and the international tax expert, is, are there any limitation on a state or a country with respect to nexus? Is state empowered to levy tax on any person or on any object, irrespective of its boundary? So there are two views to that. View one school of thought says that no, there are no limitation on the tax jurisdiction of a state. State has an unlimited power to sort of enact any kind of revenue law, whether that law is applicable to Indian citizen or to a foreign citizen. That is absolutely no restriction. Of course, you have to sort of do everything in light of the constitution of your country. But let's say, what if the constitution also allows? So, a state being a sovereign, there is no sort of practically or theoretically any kind of restriction. And this is the fact. Not only a thought, but it is a fact. But now let us come to view two, which says that limitation imposed by the customary international law. Now, what is customary international law? It says that yes, there is an unlimited power, but that power is still limited by virtue of customary international law, which says that it's so customary international law is not something which is defined anywhere. It is set of rules. It is set of the unwritten law, which says that you cannot go beyond your territory to ensure that the peace is maintained. There is no conflict among the jurisdictions. So everyone will have to ensure that there is a reasonableness in the law. And that is called a disciplinary preposition, where you don't have to sort of cross your boundaries beyond a reasonable limit or beyond a reasonable reason. There's a wonderful book written by Professor Gadzo Stephen, when he has also discussed about the concept of nexus at a great length, and he has attempted to sort of define it in a very interesting manner. He says that the prevailing view in contemporary tax scholarship is that general international law poses limits not only on the enforcement facet of tax jurisdiction, but also to its substantive facet. So what it says, the international law, the customary international law, that ensures that, so there are two jurisdictions that each state has, rather practically three. What kind of jurisdiction do we have, or each country have? One is the legislative or a prescriptive jurisdiction. Another is the executive jurisdiction or administrative jurisdiction, or you may also call it as an enforcement jurisdiction. The third one is the judicial jurisdiction. Now, so far as our discussion would be restricted today on the legislative and enforcement jurisdiction, they are very interconnected in a sense that when you create a law, a tax law, you also need to enforce it. So the legislature or a prescriptive team is closely linked with the enforcement or the administrative team. So the laws are closely linked. Now, what it says that generally it is a belief that the international law poses limits on the enforcement facet of a tax jurisdiction, that you cannot enforce a law beyond your own territory. That's an understanding and agreed approach. But it also applies to the substantive facet, meaning thereby the legislation. Well, the nature of limit is not expressed in a wholly consistent manner. To what extent you can limit, there's no agreement, nothing is mentioned. However, common denominator can be identified in a form of a requirement for a qualifying connection between the state wishing to exercise its taxing power and a particular set of facts which are relevant for taxation. Only when this qualifying connection is established is the exercise of tax imposing and tax collecting powers of the state are lawful from an international tax perspective. Now, this is what we call the connecting factor or the tax nexus. What kind of or what type of nexus that we see in common? So for income tax, we see residence. We tax the person based on his residency. We tax the person based on his citizenship. US is an example. If you are a US citizen, then your worldwide income is taxable in US just because you are holding a citizenship of US. And source. Now, source is a very subjective term and it keeps on expanding. And we'll discuss what is the meaning of source and the concept of nexus. When it comes to VAT or a GST, then it is the consumption. Where the goods or services are consumed, that state has got a right to tax that transaction, irrespective whether you are a resident or a non-resident in that jurisdiction. Property tax. In that situation, it is the location of property which is important, whether it is a municipal tax, whether it is a stamp duty or any kind of tax which relates to property. It is the state where the property is located that has got a primary and the absolute right to levy that tax. This is about nexus. Then the last, of course, is the inheritance tax, which you don't have here. But then what it says, often there is an issue whether the deceased, where the deceased was resident, that state has a right to tax, or the state where the beneficiary of that property is resident, that state has a right to collect the inheritance tax. There is always a conflict, but then again, that is one of the classic example or the type of nexus. Evolution of the nexus concept. So see why there was a need to sort of debate or to develop some theories around the nexus concept. So in the early 20th century, when the cross-border transaction increased, volume increased, the League of Nations in the 1920, they sort of referred the matter to the four economists and they told them, okay, you study this and then come out with some of the suggestions. So there were two theories which were developed to deal with the international double taxation. One was the exchange theory and another was the theory of economic allegiance. Now, exchange theory, what does it say? It says that why do I have to pay the tax to the state at first place? I have to pay the tax to the state for availing various services. Take the example. It is the state which provides you the laws and ensures that the laws are administered and enforced. It is the state that provides you the defense or the police protection. It is the state that develops the infrastructure for you so that you can carry on your business smoothly. So this theory, exchange theory, largely says that, okay, it is only when I avail or am entitled to avail the particular facility in a particular country, only in such situation I should pay the tax. This theory is valid on that principle. But yes, the problem comes, how do you enforce that theory? You can't enforce it. How do you quantify to what extent you have availed the services and to what extent you have to pay the tax in a particular jurisdiction? And therefore, practically this theory doesn't work. Then comes the theory of economic allegiance. What does this say? They have said that the economists suggested the theory of economic allegiance, and they said that there are four concepts of economic allegiance. One is the origin of wealth or income, another is the situs of wealth, third is the possibility of enforcement, and the last is the residence of a person. Now, out of these four principles, they said that the two most important are the source principle and the residence principle. And on this basis, the tax structure or the double taxation of should be avoided. Now, we all see that the treaties that have been signed across the world, more than 3,000 tax treaty, and India alone had signed more than 95 treaties. This concept is in prevalence. Now, Now, the economics concluded that the greatest weight should be given to the origin of the wealth, that is the source, as well as the residence. However, they also ensured that in case of a conflict or in case of a non-agreement, what you can do, you can evaluate which is the state where majority of the factors out of these four of the economic allegiance factors are prevalent. If the transaction is happening between two states, in that case, you identify, for example, where the activity takes place, where the capital is, where the intangible assets is, where the employees are, where the source of revenue is. So all these factors, wherever the weightage is more, that country will ideally will have a right to tax that income proportionately or entirely. So in nutshell, in allocating a jurisdiction to tax to the business profit, the importance has to be attached to the nexus between business income and the physical places contribute to the production. So largely, if you see that they did not touch upon the concept of physical presence exclusively. They dealt with the concept of economics, economic allegiance. But what we chose was at that point of time what is practically possible to implement. And at that point of time, we never had any kind of digital businesses or any kind of e-commerce companies or any kind of internet or computer. So why theory of nexus has gained importance now, a significant importance, and why there is a lot of discussion happening at the OECD and United Nations about the concept of nexus. So it is for the variety of reasons. It's not only about the taxation of the digital economy. First and foremost is the concern about the tax avoidance. Take a simple example. I am a person resident in India. I want to sort of carry out the transaction or enter into some new business venture. Or let's say I want to sell some property which is situated outside India or shares of a company which is situated outside India. If I sell the shares, capital gain arises. The capital gain is going to be taxable in India. What I can do, I can simply switch my residency. I move to another country. I become non-resident for Indian tax purpose. And I plan my affair in such a way that the transaction is not taxed in India because I'm neither having residency in India nor I have got a source in India because that asset is situated outside India. Same happens in case of a POEM or a CFC regulation. States making, that is the one reason. Second reason, states making new claims to the tax legislation. Classic example of a Vodafone case. So we all know, I'll not get into a great detail in Vodafone case, but what happened? There's a company non-resident in India situated in state A. There is another company non-resident in India situated in state B. Company A and Company B, they transferred the shares of Company C, which is again a non-resident situated in Cayman Island. Now, what happened? The department alleged that this transfer of capital asset, which is situated outside India, though the transaction is carried out between two non-resident, it is going to be taxable in India. Why? The primary allegation was that the assets, the shares of a foreign company derive their substantial value from the assets in India. That was the primary argument on substance of the transaction. But then the Supreme Court said, okay, wait, look, you have to look at the transaction, not the look through the transaction by getting into the nitty-gritties of Section 9, and ultimately it favored the assessee. But then eventually, as we all know, the law was amended and subsequently retrospective amendments were brought into statute in Section 9. The constitutional validity of Section 9, it has not yet been challenged, and only the time will say whether the explanation 5 to Section 9, whether it will hold the law or it will hold the field for a longer time. But yes, the law is evolving. Similar things are happening across different jurisdictions. So we have to see and wait for that. The third primary reason is the dissatisfaction with the existing rule. Now, as I mentioned earlier, the economic allegiance theory, the concept of source vis-a-vis the concept of residence, that was at a time when everything was happening in a brick and mortar situation where largely one country or the resident of one country would own certain immovable property from where the extraction, minerals, natural oil, or any kind of extraction activity takes place. So it was that limited to that. And then eventually the trade increased. So they said, okay, these are the reasonable basis, give a limited sort of power to the state of residence, limited power to the state of source. But then nobody thought that we'll have a digital business model. Today, you can earn the revenue in the form of advertisement just by developing a website, and you can reach out to the customers anywhere in the world. You can purchase the digital content sitting in India without any kind of restriction or because there is nothing physical involved in it. You can watch videos on the Netflix or Disney Plus Hotstar or whatever it is. Where the country is located outside India. Does it have employee in India? Answer is no. Does it have server in India? No. Does it have any kind of presence in India? No. Whether it has entity or registration in India? Answer is no. But still, you can avail the services, give the revenue. So what is happening is you are giving a lot of market to the foreign companies, but still no foreign companies paying tax in India. Why? Because the laws are not adequately drafted to sort of catch hold of those transactions. So these are all the problems that we are facing, and then that's where the concept of nexus has evolved. Multiple taxation. Now, for example, we are seeing equalization levy, digital services tax, web tax, and there are a variety of taxes in different jurisdictions. Broadening of arrangement for the cross-border assistance. So in every treaty now we see that there is a article on the exchange of information and cross-border collaboration for assistance in recovery of taxes. Now this, opens up a floodgate of litigation for each country because you have now complete visibility about your nationals, what kind of transaction they are entering into a foreign jurisdiction. So any transaction that goes untaxed, then you try to create sort of a law and you try to tax, and this creates a chaos. So therefore, the important aspect is what is the meaning of nexus, and do we still have a right as a sovereign nation to tax the transaction out of our country, or vice versa, whether we have to tax the transaction in India for those who are non-residents. So, and if yes, to what extent? This is a historical background of the Income Tax Act or the income tax in India in person. First, as early as in 1860, Sir James Wilson, so he introduced the concept of income tax first time in India, in the British India, and then he the objective was very limited to sort of fund certain certain deficits at that point of time because of the mutiny that was caused by 1857 activities, and then eventually that was abolished because it was for the limited purpose or for the limited duration. Then we saw that increasingly on trade and profession, the license tax, certificate tax that was introduced, but then again for a short period of time to fund the crown. For the first time in 1969, the income tax as a regular income tax was introduced for all the citizens of India, and that was abolished after 5 years because the government realized, okay, yes, now we have the adequate funds to fund our activity. So that was the maturity at that point of time, that the income tax was thought to be enacted only for the limited purpose when there is a deficit. Today, we are always running into deficit. That could be the either situation, or alternatively, we have a lot of surplus funds, but we have never understood that why the Income Tax Act at first place was introduced. We just want the money. Again, in 1918, the concept of 6 heads of income was introduced in this statute, but then at the recommendation of the All India Income Tax Committee, the statute, a Comprehensive Income Tax Act, was formed for the first time in 1922, and that legislation lasted for 40 years. And finally, in 1961, we did a complete revamp so that to simplify the law, but now we know to what extent we have simplified. Scope of taxation. Charging section and section 5, these are the heart of the provision of the Income Tax Act. Charging section, we all know, I'll not get into much detail because we have a lot of things to discuss. Section 5, scope of total income. So largely it says that if the income is received in India or deemed to be received in India, India will have a territorial right to tax that income. If the income accrues in India or arises in India, or it is deemed to accrue or arise in India, what is deemed to accrue? That is defined in section 9. So today our discussion is not restricted. Our discussion is not going to be in relation to income. So we are skipping this part so that we can cover the main aspects. Concept of nexus. This is very interesting slide, which I just prepared 15 minutes prior to getting into this session. So if you look at section 9, then, so 1961 Act that was enacted on 3rd September 1962. At that point of time, as you can see, this is what was the part of section 9. This is what was section 9, not part. This is the entire section 9 when it was 1961. Basically, the provision was borrowed from the erstwhile 1922 Act, 42 of the 1922 Act as it is, and it was kept as a part of. Largely, it covered 3 transactions. One, when a non-resident is having business connection or a property in India. Number 2, when there is a payment in the nature of salary by the government or any other person in India. And the last one, about the taxation of a dividend. If the Indian company is paying dividend to a shareholder or a person outside India, then it is taxable. This is what it was. Nothing much. Section 9. What is the situation today? From half a page or a quarter of a page, we have come to 14 pages alone contributed to Section 9. We have 120 plus footnotes and amendments carried out in Section 9 in the last 60 plus years. We have, I don't know how many clauses and subclauses and provisos that have been inserted and that have been removed multiple times under Section 9. We have numerous circulars, notification, judgments, and yes, the controversies around Section 9 and it's the scope of taxation. So this is where we have evolved, I wanted to highlight. So what it was, 911 to 914, business connection. So for a transaction which is carried out by a non-resident, it will be taxable in India if the non-resident has got a business connection in India, property or asset or source of income in India. So if that is the transaction, what is the nexus? The nexus was you either have a business connection or you have a property, asset or source. So the property or the business connection becomes the nexus. Then we have a salary. Then the nexus changes. If the non-resident is earning the income in the nature of salary, then the place of service becomes a nexus. If the service is rendered by sitting physically in India, you have got a nexus or you have got a right to tax. 913, salary received by Indian citizen from a government of India. In that situation, contract with the government of India becomes a nexus. 914, dividend. If you hold the shares of an Indian company, that becomes the nexus to tax that transaction. Then we never had the concept of FTS, royalty or interest or any other kind of significant economic or insignificant economic presence. Then we had a decision of Supreme Court in Carborundum and Company, and that led to the creation of 9156 and 7 in the Section 9 of the Income Tax Act. What were the facts involved? Assessee, a foreign company, simply provided a technical know-how relating to manufacturing of certain products to an Indian company. So Assessee was a foreign company. The quantum of revenue was 3% of the sales that are undertaken in India by an Indian company. That was a royalty or a technical services that was paid. When the matter reached to the assessing officer, the officer observed that assessee has claimed the refund of entire taxes which have been withheld. And then he said that, okay, no. So in this case, 5% of the technical fee paid would be deemed to be taxable in India by under as a business connection. And therefore, this 5% was a reasonable test that was applied by the AO. The commissioner observed, commissioner in fact revised the order of assessing officer, ITO at that time. He said that, okay, no, 75% of the fee would be taxable in India and that is deemed to be accrued or arising in India and then accordingly taxable in India. When the matter traveled to the Supreme Court completely sort of negated the option of assessing officer as well as the commissioner. The court said this income is not at all taxable in India. Why? Assessee is a non-resident. The concept of business connection is there. But then for a business connection, you need to have certain activities in India. If the services are not rendered in India, then you cannot tax that transaction irrespective whether it is a technical fee, royalty, or what kind of. Okay, so they have not dealt with the royalty in this case, but yes, you cannot tax the fees for technical services. So that is what the Supreme Court says in case of carborundum. Now, to sort of this judgment was not in the context of Income Tax Act 1961. This judgment was in the context of Income Tax Act 1922, Section 42. Now, because this judgment was rendered post enactment of 1961 and the provisions of erstwhile law and the new law were pari materia. So the Finance Bill 1976, they expanded the concept of nexus, and that was for the first time the concept of nexus was expanded under the Income Tax Act for the non-resident. So what it said that we'll introduce the concept of FTS, royalty, and interest in the state in the statute. You all know it has been there since 76. Interestingly, in the memorandum explaining the bill, what they said, in order to avoid any doubt or dispute in regard to the accrual of income. So what they are trying to say, the provision that they are bringing in That was always there in this statute. It is just that they are expressly coming out. Now, this is irrelevant in this case because the provision was not there. It is for the first time that they introduced. So this clarification will not create any kind of retrospective taxation. So this is where we have interest, royalty, and FTS introduced by 1976 Act. What is the nexus in these type of transaction? In case you pay the interest and you are a government of India, then merely because you are a government, the nexus is created, no more questioning. Whether the payment is for business in India or any kind of service in India, forget about it. It is taxable in India as long as you are a government. If you are a resident in India or you are a non-resident in India, then you have to see the place of utilization of a particular loan in case of payment of interest. In case of royalty, the place of utilization of a know-how, property, or information. That becomes the nexus. In case of fees for technical service, again, same, the place of utilization of right, property, or information becomes the nexus. So the concept of nexus was expanded from business connection or the contract of employment to payer. Now, again, the matter reached to the court. The constitutional validity of the concept of FTS was challenged for the first time in the case of Electronic Corporation of India Limited. So two aspects. Of course, the question before the Supreme Court was the facts involved were the assessee, a Norwegian company that provided again the technical know-how and technical services to an Indian company. The question was whether withholding taxes or whether the transaction is taxable in India or not. And if yes, whether the parliament has got an sort of unlimited or an extraterritorial whether the law enacted by parliament, which is section 917, can it have an extraterritorial operations? Because the Norwegian company did not perform the services in India, the services were performed outside India. Can it still tax that transaction? Can India tax that transaction? That was a larger question. Now, Supreme Court in case of in this case of ECI referred the question to the larger bench. But in that case, the ECI, which was probably the public sector undertaking at that point of time, they withdrew their appeal with respect to the constitutional validity of Section 917, and therefore the constitutional validity of this provision could not be examined in the 1989. It is important to sort of refer to Article 245. I think we'll see it, but before that, what was the observation of the Supreme Court in case of ECI, which is very important? The Supreme Court says that question whether a nexus with something in India is necessary. It seems to us that unless the nexus exists, the parliament will have no competence to make the law. That is very clear because Section 245 itself also talks about this concept of territorial nexus. It will be noted that 245(1) empowers the parliament to enact the law for whole of territory. The provocation of law must be found within India itself. Such a law must have an extraterritorial operation in order to subserve the object, and that object must be related to something in India. So now this is where the important point to highlight is that object must have something to do with in India. Something in India. So parliament and legislature in India can enact the law. No question about it. The question is, can that law be extraterritorial? Answer is yes, it can be. But then you have to ensure that the object which is sought to be taxed, it must have something in India. You cannot simply tax something which is beyond your territory. That is what was the observation. But then again, because the matter was sort of appeal was not pressed and it was withdrew, so therefore the court did not adjudicate this matter completely. What does Article 245 says? It is very important to stop here and see what the territorial connection and extraterritorial operation article says. So it is part 11 of the Constitution of India. It deals with the relation between the union and the state. Extent of laws made by parliament and by the legislature of state. Subject to the provision of this constitution, the parliament may make laws for the whole or any part of the territory of India, and the legislature of a state may make laws for the whole or any part of the India. Okay, so the powers are divided. Parliament can make the law for whole or any part of territory of India, and the legislature of state may make law for the whole or any part of the state. Now, Para 2 says the no law made by Parliament shall be deemed to be invalid merely on the ground that it would have extraterritorial operation. This is what the revenue would always or usually argue when the law is sought to be challenged on the extraterritorial operation. Now, please understand, while this Article 245 has been dealt with by the court on multiple occasions when it comes to extraterritorial jurisdiction of the parliament, what was the historical background behind Article 245? The Constitution came into force in 1950. Prior to that, we had Government of India Act 1935. In the Government of India Act 1935, there was an article or a section 99, which was largely similar to Article 245, or so to say, Article 245 is similar to what was contained in Section 99 of the Government of India Act 1935. What was the purpose of enacting that article or a Section 99 in the Government of India Act? Before independence, we had on one side, we had the princely states. On the other side, we had the British India. 60% of the landmass was under the control, physical control of the British India, and 40 or 42% was with the princely state. There were around 562 princely states. The question was, while framing the 1935 Act, how do we divide the powers between the princely states as well as with the crown or the British India? So they brought in the Section 99 in the 1935 Act, and they said that, okay, let's divide it in this manner. And the purpose of extraterritorial operation, it had nothing to do with anything outside of British India. The purpose of extraterritorial operation was or had everything to do with what British India does. Is it going to affect or can it be enforced in the princely state? So they said, okay, yes, it can be enforced. It can have extraterritorial operation. But then the condition or the situations were also given. Say, for example, an army personnel of British India territory, if he is serving in a princely state or the ambassador is a princely state, in that case, or some kind of government employees in the princely state, the taxation aspect or all kinds of law relating to that person or an individual or even the government or a company owned by British India, if it has got an operation in the princely state, then everything relating to that entity, though that entity has gone outside, it will outside of the British India, it still would be within the purview of the British India. That was the objective with which Section 99, which is exact replica of 245, was enacted. But we are challenging the extraterritorial jurisdiction of the parliament. Take an example of equalization or SEP concept. We'll see, can they be challenged under Article 245 or under different constitutional provision? Take the example of Article 265, which says that without authority of law, you cannot sort of enact a law, or no tax can be collected without authority of law, which is the proper section that it still is a question to be decided. One more interesting aspect is Article 51 of the Constitution. It says, Article 51 says, deals with the promotion of international peace and security, and Para C says to foster respect for international law and treaty obligation in the dealings of organized people with one another. Now, there is an implicit assumption in this that the nexus concept cannot be expanded in an unlimited manner. You have to restrict it up to a certain level so that you can follow the international unwritten law. Take the case of Ishikawa Jima Harima Heavy Industries, a Japanese company, or a Japanese company which had sort of entered into a contract with the Indian customers with the consortiums in India. So what was the nature of contract? It was a turnkey project. So there were 5 parts of the contract: offshore supply, offshore service, onshore supply, onshore service, and construction and erection. What was the issue? Because we have 15-20 minutes, so I'll just expedite on the speed, but yes, we'll spend some time if anybody has question at a later stage. So what was the issue? Taxability of offshore supply equipment in India and to what extent? Taxability of offshore service in India and to what extent? Now, there was a provision of service. The question was not about the onshore supply or onshore, because that is any which way taxable in India, activities carried out in India. When it comes to offshore supply, that is from Japan or from a foreign country, if the service is provided or a manufacturing activity takes place outside India and sales is concluded outside India, uh, in relation to the contract in India, is it going to be taxable in India? The department looked at the contract in a composite manner and they said that everything is closely connected and the jurisdiction to tax this transaction rests with India and we can tax the transaction in its entirety. Of course, we'll restrict it to the profit attributable to India. Now, the SSC argued that no, offshore supply and offshore service cannot be taxed in India and they challenged the constitutional aspects of that legislation. So, for offshore supply, the Supreme Court observed about the nexus. Since all parts of the transaction in question, that is transfer of property in goods as well as payment, was carried out outside the Indian soil, it cannot have tax implication in India. The principle of apportionment, where the territorial jurisdiction of a state determines its capacity to tax an event, it has to be followed. So at that point of time in 2007, Supreme Court again reiterated the principle of territorial nexus and they said that state cannot tax levy transaction which is not carried out under the borders of that state, irrespective whether it's a composite or a divisible contract. But in this case, SSC proved it was a divisible contract, so the matter favored him. Offshore service. Again, the Supreme Court mentioned a very important principle. There has to be a sufficient territorial nexus to tax the foreign national or a foreign company. They did not mention only about the territorial nexus. They said sufficient territorial nexus. In the absence of sufficient territorial nexus, you cannot tax this transaction. This is what was held in Ishikawa-Jama Hariwa Heavy Industry. Now, on the 917 applicability, they mentioned that the services should not only be utilized within India, but they should also be rendered in India. The revenue argued that, okay, agree, the service was not rendered in India. But because the service was utilized in India, we are going to tax it. The Supreme Court said, no, stop. You can't tax this on the basis of utilization principle. For the purpose of taxing the FTS transaction, the service must be rendered in India or it should have a live link with India. This is what was held. Then what happened thereafter? Again, amendment by Finance Act 2007. They brought in a retrospective amendment. And thereafter, they also brought in a circular immediately on 12th March 2008, dated number 3 2008, which broadly explained the provisions of Finance Act 2007. So the last line is important, which I have highlighted here. So largely, they dealt with the explanation, and the explanation basically sort of tried to done away with the requirement of rendition of service or the done away rather with the requirement of having any kind of business presence or connection in India for the purpose of taxation of FTS in India. So that was an amendment in 2007. I'll just highlight it here. So the amendment brought in by Finance Act 2007 was only up to the stage they done away with the condition of residency or a place of business in India or a business connection in India. That was amendment by Finance Act 2007. That explanation was inserted with retrospective effect. But then what happened? The another case came up before the Karnataka High Court. Again, almost similar transaction. Foreign company providing services to the Indian taxpayer or to the Indian service, the person who is availing the services. Authority claimed that no tax is leviable in India. TDS is required to be withheld. The matter traveled ultimately to the Karnataka High Court, and court said that, okay, even after the amendment, a retrospective explanation inserted by the Finance Act 2007, still the law laid down by the Ishikawa Jama Harima Supreme Court will still hold the law, because what the Parliament has brought in is they have done away with the requirement of place of business or business connection. There is nothing mentioned about the rendition of service in India. So therefore, to that extent, they said that, okay, the law will hold good, and therefore we are going to sort of give the complete exemption to the taxpayer. So ultimately, the decision was in favor of assessee. And on the same line, we have a Bombay High Court decision, which is again a landmark decision in case of Clifford. Again, the revenue, by its very nature, they brought in the amendment, Finance Act 2010. They removed or substituted the erstwhile explanation and again expanded the concept of nexus for FTA's royalty and interest. They said that for the removal of doubt, again, it is declared. So that's a declaratory amendment. not even a clarificatory, that the income of a non-resident shall be deemed to accrue or arise in India with respect to interest, royalty, and FTS, irrespective whether the non-resident has a business or a place, has a residence or a business place in India or a business connection in India. That is number one, which was always there. They expanded it to say that even if non-resident has not rendered a service in India, we will still tax that transaction. So in case of a FTS, royalty, or interest, you have to forget whether the non-resident has got a business connection in India, whether the service is actually rendered in India. Transaction is completely taxable. Whether the law laid down by Supreme Court even after 2010 amendment still holds the law, some of the case laws have said yes, it is. The constitutional validity of the amendment is yet to be challenged. We'll see as we sort of progress. GVK Industries, the first case where the Supreme Court dealt with the concept of nexus in an elaborate manner. What was the issue? Again, the transaction of payment in the nature of financial consultancy or technical fees to a non-resident. The question arose whether the transaction is taxable in India. Second, whether the parliament has a power to enact a law which has got an extra territorial operation or extra legislative operation. The matter traveled from the Andhra Pradesh High Court, similar to ECI. ECI was also coming from the Andhra Pradesh, and this GVK industry also came from the Andhra Pradesh High Court. But the court said yes, but it did not dealt with the constitutional validity or extraterritorial aspects of the provision. The ECI case was about 1989. GVK came in 2011. Almost after 20 years, the same question came before the Supreme Court, for which the appeal was previously withdrawn by the assessee challenging the constitutional validity. Now, at this point of time, what happened ironically, again, the appellant withdrew the constitutional challenge before the Supreme Court. At the insistence of Department of the Attorney General, the court sort of proceeded with the concept of nexus without there being any kind of submission on the part of counsel of the assessee or the assessee itself. There was no ground which was praised on the constitutional, yet Supreme Court moved ahead. And what Supreme Court says? So in this GVK case, Supreme Court says that it is obvious that the parliament is empowered to make the law under Article 245 within the territory and even with respect to extraterritorial aspect or causes that have an impact on or a nexus within India. Now, this is obvious because this is written in the constitution itself. What the court did not deal with this aspect was, can a parliament can have extraterritorial legislation? That is what was important to be examined, which court never went into that aspect. There was no discussion around the sufficiency of nexus or to what extent the nexus connection is required. To that extent, I think the discussion should have happened, but it did not for whatever reason. Then court should have gone into that aspect. It unfortunately could not be discussed. Interesting. Recent time, we are seeing in the newspapers that the pollution in Delhi, it is also caused by the Pakistan or by some of the activity or the stubble burning or the agricultural waste that is being burnt in Pakistan. So the air gets polluted and accordingly, the Delhi situation we all know. So the question that comes is, can Parliament enact a law to tax the foreign companies or a foreign citizen who are resident of Pakistan that have got nothing to do with India, or the agriculturist in Pakistan that have got nothing to do with India, to discourage them from doing the burning, agricultural waste burning, so that to control or contain the pollution in Delhi? If that is the reality, can it do so? Now, if you refer to the judgment of GVK Industries, invariably it gives an unlimited power to the legislation or the sovereign to tax or bring in any kind of transaction within the purview of taxation or brought in any kind of law, as long as they say that I've got a nexus within India. What is nexus? What is sufficiency of the nexus or adequacy of the nexus? That is not dealt with in great detail in GVK Industry nor in any other judgment. So going by GVK Industries, yes, tomorrow we can have a section under the Income Tax Act which says that, okay, we will tax a person who is a resident of Pakistan, who is carrying out a particular set of activity, he'll be taxed on his income. We can. When the question comes about the enforcement, again, we'll be limited by the customary international law. But then again, the Supreme Court has said that merely because the customary international law limits the enforcement aspect, we cannot sort of say that the law has become extraterritorial or law is an extra legislative. So answer is yes, India can frame that law. But that's again just for a theoretical discussion and impractical thing. So in the interest of time, I may not. So we have 5 minutes to go. We'll just touch upon how we have come so far. So 1976 was major year. Then we have 2012, which is not there, but then post Vodafone, the amendments that we saw in Section 9, the draconian amendment, the way they expanded Section 9 to cover the offshore transaction. And then we saw in 2016 the equalization levy on the advertisement services. In 2018, we saw the introduction of concept of significant economic presence in Section 9, which expands the meaning of the definition of the business connection. Again, in 2020, they brought in the concept of EQ levy, but yes, thankfully, they have abolished it in the recent budget. In July 2024, they have again abolished this equalization levy because that was a temporary measure understood by everyone. And in 2021, they again expanded the provision of SCP and enforced the provisions of SCP, made them effective. So let us just briefly touch upon. So these are the business models which we discussed earlier, quite evolving. So the concept of nexus becomes all the more important. These are the revenue models that we see these days: subscription-based revenue, advertisement-based revenue, digital content purchase and sell happening online, rental happening online, the licensing of the content and the technology happening online. So these are all transactions which were never visualized when the Income Tax Act was enacted. But then whether the existing inbuilt concept of nexus is sufficient enough to tax these transactions, that is only the time will tell. OECD commentary on electronic commerce. OECD has earlier sort of gave out a commentary on the e-commerce, although it did not expand the definition of permanent establishment. And they say that, okay, yes, there is a nexus which needs to be relooked at. And they said that there are various parameters. One of the parameter is the computer equipment or a software, and another parameter for e-commerce transaction is the where the so to say the source code, or so to say the server is located. So if the server is not in India, India cannot tax the foreign companies doing business with India through the e-commerce platform. That is what the largely OECD concludes. But then India says, no, we have an innovative way of taxing this transaction. What says India says? India says we don't agree with the OECD commentary. In the OECD commentary, you will find the reservation given by India. And interestingly, in an interesting manner, the India is trying to tax the e-commerce transaction, or it is attempting to expand the concept of nexus. It says that if a user in India goes to the website of Amazon US, now, as we all know, those who are tech savvy, they will agree with me that when you log into the website, the cookies automatically get downloaded in your computer, and through those cookies, the website owner or that website gets certain information from you. So when you click on the website, they ask you, do you agree with the cookies? Yes, then they give you an access. Then certain files are downloaded automatically without you knowing in your laptop, and those temporary files will collect the information about you, about your geography, which IP address you are accessing the computer through, or what is your interest, and all those things are happening. So the Indian government says that the moment an Indian user opens a website or clicks on a website, this website will have access to that computer, and this access creates or gives the nexus to the Indian legislature to tax that transaction. So what I have to do when I log into that website, I may deny the cookies, meaning thereby, if I deny the cookies and still if I enjoy the website and pay some revenue to the foreigner, I'm not taxed in India. But the moment the cookies are automatically downloaded, then I'm taxed. So I think this is quite impractical approach, which is something you are going to legislate, but you cannot enforce. So they have amended the companies rules also to ensure that the foreign companies comply with the Companies Act wherever they have got a sort of a nexus within India. We have famous case of Kolkata ITET in case of Right Flourished, where again the court dealt with taxation of website, and they said that that is not taxable in India in the absence of any kind of permanent establishment or a business connection in India. Court disagreed with the view of the revenue on the OECD commentary, which we just discussed. On same line, we have other judgments as well, but because we are short of time, we may not be able to deal with each of those aspects. But in sum and substance, you can see that from a brick and mortar situation, we have come a long way where at some point of time, the nexus was created by having a presence or an activity in India. A famous case of R.D. Agrawal, wherein the court held that even an isolated transaction cannot create a business connection in India. There has to be a continuity of an activity in a particular jurisdiction to ensure that it is only in that case you can have a business connection. So we have come a long way where even now in an SCP, if you enter into a single transaction which is more than 2 crore, irrespective of having a presence in India, any employee asset, nothing in India, you create a taxable presence in India, you have got a business connection, and you have got to give a hell lot of information to the civility to ensure you don't deduct the tax. Again, BEPS, I think we may not be able to discuss everything, but yes, one important concept of SEP, significant economic presence, that was brought into statute by the Finance Act 2018, wherein the objective was to tax the digital transaction predominantly, which are happening in India. If you can see the highlight word, the word is in India in the first line. And eventually they expanded this concept to in Finance Act 2020, they again replaced the erstwhile Finance Act 2018 provision with a complete new provision. And they said that if a non-resident is doing a transaction with any person in India, so from in India, they move to with any person in India to again create a nexus with you. So we are not going to look at whether you are actually in India or not. We are going to tax you. This is what the Finance Act said. Thankfully, we have got treaty with majority of the countries, and still SEP is no more a challenge, but yes, definitely the compliance is increasing like anything. So I think with this, I'm concluding my presentation because I don't want to take the time allotted to Prashant. This is the interesting slide, international chaos. It is not only in India, across geographies, the countries have sort of introduced variety of taxes and created the new thresholds and nexus concepts, which will only, create a chaos and worsen the situation rather than creating a balance in the taxation jurisdiction. So with this, I would like to thank you. In case there are any questions, please feel free to ask.
Yes, sir. Yes. After such a powerful presentation and a power-packed knowledge sharing by Karan sir, I think it really helped all the participants of this webinar. Now we have some questions, sir. Participants are asking. This is Jagannathan Seshadri from Chennai. He is asking on the issue of nexus in connection with the extraterritorial jurisdiction, whether the Vienna Convention has a great influence than the Parliament.
Yes, that is a very, very interesting aspect. So as I mentioned, there are two set of laws. One is state is a sovereign. So state or the constitution, they can, in whatever way or to whatever extent, they can enact the law. They can even amend the constitution to have an extraterritorial operation. Nothing doing. But there is another side of it, that is customary international law. Vienna Convention is one classic example of that customary international law. Take a very particular, I'll just address it in a simple way. There's a very interesting line in the Vienna Convention, Article 31, which says that treaties are entered into good faith and they have to be enforced into the good faith. So there's a good faith concept in treaty, meaning thereby, in good faith means you are not going to enter into a territory of another person. That is also a part of good faith. So while India is not a signatory to the Vienna Convention, largely all the countries, or particularly in India, they ensure that they observe the rules which are set out and agreed in the Vienna Convention. Legally, not binding, but morally it is binding. Whether the courts have upheld and enforced the customary international law, answer is yes. Not only in India, across jurisdiction, you will see a plethora of cases where the courts have upheld that yes, customary international law would impose limitation. I'm not saying they're overriding the statute, but yes, they would impose limitation on the statute which has got an extraterritorial operation. So even the real test of the validity of a law should not be based on the Constitution of India. If the law is having extraterritorial operation, it has to be on the basis of customary international law.
Yes. Thank you, sir. Sir, one question is from my side actually.
Yeah.
Uh, Sir, is there any impact on the ECB transactions yeah, after in all these provisions, whether ECB transactions fall in these categories? If I borrow
ECB,
from the entity registered outside India, okay, borrow from that entity directly, foreign entity, so whether these provisions come into play under
yes,
ECB
I think
policy?
India already has like in section 915, if you read, which deals
Hmm.
with payment of interest.
Hmm.
So it always says that if you make a payment of interest to a non-resident,
Hmm.
that transaction is taxable in India.
Right.
Now, the amendment by Finance Act 2010 says non-resident is not required to have a business connection in India. Non-resident is not required to render services in India. In case of interest, this is not applicable. So if the payer is an Indian resident, is
Right.
making payment, as long as the utilization of funds is happening in India, you have to deduct TDS. If the utilization of funds is not happening in India, in that case, if it is happening outside India for the purpose of business, then you don't have to deduct TDS. So
Okay.
that is very settled under the statute now.
Yeah. Okay, sir. Thank you. Thank you so much for giving your time. And hopefully we will arrange the next seminar soon with you on the any new
I
topic
think
or the similar topic on a vast subject that I saw that various slides have uncovered due to
yes, yes, yes.
time
Yes, it is
issues.
difficult.
Yes,
Yes,
yes.
it is difficult to cover
Yeah.
everything in 1 hour.
Yeah, yeah, yeah.
And there were a lot of concepts
Yes, yeah.
and there were a lot of issues that were required, but it requires a lot of time.
Yes,
So
sir.
that's why my discussion was on the territorial
Yeah.
and evolution of the territorial nexus.
Mm.
And it has now become aerial, not a
Right.
territorial, it's an aerial nexus.
Right, right.
So that's why I restricted myself to the concept and not sort of deep dived into the
We will try to
provisions.
cover in the next session, sir.
Sure,
Uh,
definitely. We can
Thank you, sir.
continue in the same
Yeah, sir.
topic. Thank
Thank
you
you, sir.
so
Thank you,
much.
sir.
Thank you,
Yeah,
everyone.
yeah. Now moving ahead, we have our next session on direct tax Vivad se Vishwas scheme. For that, we have with us CA Prashant sir. Welcome, sir. Prashant sir.
Hi,
Hello.
Manish. Good evening.
Good evening, sir. Good evening. Uh, Welcome, sir. Uh, Now, immediately we will start our session, sir. Before starting the session, I'll just introduce Prashant Maheshwari, sir, in a brief, and immediately I will hand over the session to the Prashant, sir. He is a partner with EVA LLP and a leading direct tax and transfer pricing practice in Gujarat. He is a qualified CA, CS, and a law graduate with more than 17 years of experience in advising clients on various corporate tax, transfer pricing, litigation, and international tax matters. He has a very rich experience in representing various Indian international clients for complex income tax, international tax, and transfer pricing assessment and litigation matters from the stage of assessment to High Court, and has a history of getting exceptional outcomes for the clients in litigation matters at lower appellate stage. He brings on board rich industry experience and understanding varied and complicated tax issues dealt by large multinational corporations. He was instrumental in setting up transfer pricing practice in Gujarat for one of the big four firms. He is working on some of the largest income tax, international tax, and transfer pricing litigations in India. We welcome you, Prashant sir. Now over to you, sir. You can take charge of your session. Thank you, sir. Hello, Prashant sir. Hello. Hello, Prashant sir. Are you there, sir? Prashant, sir? Hello? Can you hear me, sir?
Yeah, Maheshji, sorry, there was some technical issues. I just got disconnected for a few seconds.
Okay, okay. Now it's okay, sir?
Yeah, yeah. I hope I'm audible.
Audible, sir. Yes, sir. Yes, sir. You are audible, sir. Now you
Great.
can start your session, sir.
Thank you, Maheshji, for this nice introduction. And thank you, ICAI and entire CP committee for giving this opportunity. Current was really fantastic to hear your session, and I must appreciate you have done a fantastic job. And
Thank you, Prashant. Thank you.
only thing I thought how you allocated 1 hour for this session. No one this topic in 1 hour, so I can completely understand the dilemma which you had in completing the slides.
Yes, yes, yes. Thanks to the CBDT and the Finance Ministry. So I saw that if you look at the pages, section 9, from half a page, it's tremendous.
Yeah,
All the best, Prashant.
thank you. Yes, let me just share my screen. Is my screen visible to everyone?
Yes, sir. Yes, sir.
So I think Vivad se Vishwas, the direct tax settlement scheme, which was introduced by Finance Act 24, is not something new element for all of us. We have seen this in the earlier version in 2020, just before the COVID struck, and many cases were evaluated during the COVID for the purpose of VSV, and it faced various extensions at that point in time. So this is something is a scheme where we have some amount of experience already available with all of us, and naturally when we look at the entire scheme, it always goes without saying that whenever we have a precedent available, you will always compare the scheme with the earlier scheme. Looking at the entire, let's first have a look at how VSV 1.0, which was a VSV scheme launched in 2020, was dealt with. When it was introduced, almost more than 9 lakh crores were stuck in litigation with around 5 lakh direct tax cases. And the entire scheme gave very good results as what is reported by the Press Information Bureau. More than 1.3 lakh cases got settled. Disputed taxes almost of around 1 lakh crore got settled in the entire scheme. Government also recovered around more than 50,000 crores of taxes in the entire BSV scheme. When we see the delta between the disputed tax settled and the payment against the disputed tax, basically many schemes, many cases got also settled by adjustments of the refund. Hence, it did not yield in any additional tax payment for the government, but yes, it actually reduced the litigation for the government. That scheme always had a sunset clause of 31st March, which got extended to March 21 on account of various reasons. Coming to the direct tax Vivad se Vishwas scheme, which we generally call as a VSV 2.0, the way it is introduced by Finance Act 24, this scheme is slightly more constrained, more restricted as compared to VSV 2.1, VSP 1.0. We will see how what was the differentiating factor in these schemes. And the government has also issued the FAQs almost 1 month back. So we have a lot of clarifications available, and we have various things available with us, how this schemes, what are the various situations will be dealt with in. First, the way I will just go through, then I'll try to cover the more of the informative part, what the scheme talks about, what are the various points which are covered by the FAQs, and then I would prefer to open the floor for the question and answers at the earliest, because practically many people have a lot of practical issues associated with VSV, so we'll be happy to discuss that as well. Coming to the eligible cases, when we talk about the eligible cases, basically 4 categories of cases which are covered in the eligible cases. These cases are nothing in the larger basket. These are all pending litigations at various forums, be it High Court, Supreme Court, Tribunal, Commissioner Appeals, Joint Commissioner of Appeals, which is a new forum which is created to handle small cases. Cases pending with the dispute resolution panel as on 22nd July 2024. Dispute resolution panel, if DRB has issued the directions, but issuance of the final order is still pending. Those are the cases which are covered, and any application filed by the taxpayer under section 264, any of these cases, be it appeal, be it writ petition, or be it a special leave petition, pending before Supreme Court, High Court, Tribunal, Commissioner Appeals, DRP, the way we have discussed for a couple of cases, Commissioner under section 264, orders pending before the assessing officer where the final orders are awaited but the DRP directions are issued on 22nd July 24. All these cases are specifically covered and which are eligible cases for the purpose of VSV. Now, there is a one deviation which is there as compared to the VSV 1.0. At various places, we will just compare some of the instances which were a bit more elaborate or more extensive in the VSV 1.0 as compared to VSV 2.0. In the VSV 1.0, any cases where the time limit for filing of appeal was also pending on the specified date, which was 31st January 2020 in that year, in that case, was also eligible for the purpose of VSV. That means you have received an order from the lower authorities, but the time limit to file an appeal before the higher authorities was still available to you. Those cases were covered in 1.0. Those cases are specifically excluded in VSV 2.0. In terms of the FAQ 9, which is issued by the CBDT, they have specifically clarified, since those are not falling within the pending litigation, those are the cases which are eliminated. Again, if you see, compare the VSV 1.0 with the VSV 2.0, VSV 1.0 dealt with a lot of international tax cases, international litigation which is pending at various forums. Those cases were definitely needed at that point in time. The way Karan covered in his session, a lot of litigations were happening on account of indirect transfer. To cover those specific cases, large stake litigation, those cases were included in the VSV 1.0, which definitely is not required at this point of time in VSV 2.0. To that extent, it actually simplifies VSV 2.0 for the purpose of implementation. Few cases which are specifically excluded from the VSV 2.0, search cases categorically entirely excluded. In VSV 1.0, search cases having tax demand up to rupees 5 crore were included as a part of the VSV. In this case, here it is entirely excluded. So any assessment, reassessment, or any proceedings, any orders passed on account of search proceedings, be it under section 153A, 153C, 147, 143.33, everything is excluded from the VSV. So you cannot opt for VSV for search cases. Any case for any assessment year, if any prosecution proceedings has been instituted. So if you are facing a prosecution proceedings for any of the cases under the Income Tax Act or be it under various other act, be it Coffee POSA, which is conservation of foreign exchange and prevention of smuggling activities, or various other laws which includes Unlawful Activities Prevention Act, Narcotic Drugs and Psychopathic Substance Act. They have got various provisions. I'm not listing out the entire provisions, but if a taxpayer is facing a prosecution under any of these act, under the specified act or under the Income Tax Act or any of the specified provisions, then those taxpayers becomes ineligible for the purpose of VSV. Okay, now one thing has to be very clear. The prosecution, the way prosecution is dealt, it decides your eligibility also for the purpose of VSV. At the same time, one has to be very careful when you go for the VSV. Under VSV 2.0, your prosecution under the Income Tax Act will be completely waived. But your possible prosecution under any other provision cannot be prevented because of VSV. So when you are deciding from the VSV, definitely if you are anyway facing a prosecution, definitely you anyway become ineligible to go for the VSV scheme. But if you go for the VS, because there is no prosecution proceedings pending on you as of now, so you decide to go for, as a taxpayer, you decide or you recommend your clients to go for a VSV scheme, definitely those clients will be prevented from the prosecution proceedings under the Income Tax Act. But the prosecution proceedings under any other law, be it Coffee Posa or be it Prevention of Corruption Act and any other similar act, those prosecutions something will not be prevented. So if they receive any notice post conclusion of VSV by the taxpayer still has to face those prosecution. So that is something which any taxpayer or every CA has to be very careful when you are advising your clients for the purpose of VSV. Then comes a relevant part, which is largely covered by the black money law. Any undisclosed asset or income outside India. So if you have any such cases which is covered under the black money law, even those cases something which makes you ineligible for the purpose of VSV. Any assessment which is happening on account of information received from the foreign jurisdiction from the any other jurisdiction under the tax treaty under section 90A, if any assessment is happening in the case of the taxpayer on such cases, those assessments are specifically excluded. So these are the laundry list of exclusions where if the taxpayer is falling in any of these categories, those cases will be excluded from the purpose of VSV. Now, there are few theoretical points which VSV 1.0 was specifically enacted as an act, and 2.0 is a part of the Finance Act as of now. 1.0 is specifically covered set-aside cases. If there is any set-aside cases which is coming from the Income Tax Tribunal or High Court, those cases were again covered by the VSV 1.0. But those cases are specifically excluded under the VSV 2.0, and this is something which we have already covered. If there is any enhancement notice which is issued by the authorities, enhancement power is available to the appellate authorities, be it CID or be it DRP. Those are the cases which are covered in both the cases. So if you have faced 3 disallowance before the commissioner, and as a taxpayer now you have received another 2 disallowances or the notices issued by the commissioner proposing some more disallowances in your case, then definitely you have to, even those 2 cases will be covered by the VSV. Now, such cases we have specifically discussed. Again, similar to earlier VSV, if there is a specific date given in the earlier scheme also, a specific date is given in this scheme also, which is 31st December. If as a taxpayer, you opt for VSV on the specified date, then definitely your tax incidence will be 100% or 110% as the case may be, the way your case is pending. But if you go for a date after 31st December, which is specified, which is a date for the purpose of filing an application, if you go after that date, those dates will be, then you are falling after that date, then you will be able to pay additional 5% or 10% as the case may be. If you're dealing with interest penalty, then additional 5% or additional 10% in the case of actual tax demand. In the earlier scheme, there was a marginal relief which was available. That marginal relief is not available in this. Suppose if you are exceeding, your interest consequence comes only 1 or 2% of the actual amount. So then you would have got an actual 1 or 2% of the additional demand, which is missing in this VSV scheme. This is, I think by now this is known to everyone. I'll just quickly cover this. When it comes now, new appellant and old appellant. Let's first be clear what is a new appellant means. Since VSV 1.0 was already there, if you have a case wherein appeal is filed after 31st January 2020, but before 22nd July 2024, you are a new appellant, because that is the date when the earlier VSV scheme came into existence. But if you have an appeal which is pending before 31st January 2020, you are an old appellant. So in that case, you will have a different tax incidence as compared to the new appellant. Definitely, it goes without saying, since there was an opportunity available to the taxpayer on the earlier occasion to go for the VSV, someone is not opted for that VSV scheme, and again there is an opportunity available to that taxpayer. Additional 10% incidence of taxation on that person is definitely justifiable. If you are a new appellant, you are filing your declaration before 31st December, your 100% of the disputed tax you have to pay, which will give you immunity from the interest and penalty consequences. And if you opt for the VSV post 1st January 2025, you have to pay additional tax of 110%. And similarly, if you are an old appellant, the percentages are 110% and 120% respectively. Now, if your appeal is dealing only with disputed interest, disputed penalty, or a disputed fee, if that is the case which you are dealing with, if you are a new appellant, you have to pay 20%, 25% of the disputed interest or penalty or fee, or 30%, depending on the date when you are applying for the VSV. Similarly, if you are old appellant, the percentages are 30% and 35% respectively. So that is how the entire thing goes. In the case of penalty proceedings, one has to be very clear, which is clarified by way of FAQs, that if you are a taxpayer wherein you are also facing quantum proceedings and you are also facing penalty proceedings, and if you desire to only settle penalty proceedings, that is something which is specifically prohibited. So you as a taxpayer, you cannot settle penalty proceedings keeping quantum proceedings open in the case of the taxpayer. Now, all this amount, if you have a order of the lower authorities in your favor and department has filed an appeal in your case, definitely the tax incidence has to reduce in your case, which is 50%. If you have a favorable order and department has filed an appeal before the High Court or ITT or Supreme Court, in that case you will be required to pay 50% of the tax demand. Again, if as a taxpayer, still if you have filed an appeal, but the issue involved in the appeal is covered in your case, again the tax incidence comes down to 50%. Now, this is something which is very tricky situation to determine when you have to deal with the covered cases. Often covered cases include various parameters. In case of factual cases, sometimes it is very difficult to justify before the authorities it is exactly covered or not. So I believe there are many instances where authorities exactly rely on the orders of the earlier year. Those are the years where we can definitely say these are the years which are specifically covered in the case of the taxpayer. So if one looks at the scheme, they have specifically covered the cases where the cases are pending before tribunal and cases pending before CIT appeal to decide the covered cases. High Court is specifically missing, which is clarified by way of FAQ, that if you are dealing with a case which is pending before High Court and that case is covered by the Supreme Court. Needless to say, if I am a taxpayer, I am Mr. A, I have a particular issue or particular appeal which is pending before High Court, and that issue is already decided by the Supreme Court in my favor, then definitely that doesn't remain a dispute at all. So in that case, definitely those cases will not be covered by those cases will not be treated as a 50%. In that case, though not clarified in the scheme, in my personal view, it will get as a nil incidence of the taxation. Definitely, any such settlement schemes come with a clear caveat. There will not be any interest which will be granted to the taxpayer on any refund which will be accruing to the taxpayer. Again, this is slightly tricky. Generally, as a taxpayer, we always opt for the VSV when we look at something which is more beneficial to us. And there are many instances where the taxpayers where if accumulated losses are getting lost, or accumulated MAT credit are getting lost, or there is significant amount of losses on MAT credit which is not giving any immediate cash flow impact in the case of taxpayer. In those cases, definitely taxpayers are more inclined to go for VSP because that is something which is a no tax incidence kind of a settlement for the taxpayers. But in this case, every taxpayer is provided with the two options, because practically what happens as a taxpayer, if you have say 10 crores of losses coming in from the earlier year or for a particular year, and in subsequent years, you have adjusted those 10 crores of losses. Now, if you want to go for the VSV and want to use those earlier losses for the settlement of the scheme, logistically and practically, it becomes very inconvenient for you as a taxpayer to first settle the losses and then give that impact in the subsequent year. So there is an option available. You can definitely decide not to use the carry forward losses. You can pay the taxes for the respective year and you can continue with your losses the way you have already adjusted them in the subsequent year. As a taxpayer, if you feel for you it is more beneficial or you still want to opt for the option one, wherein you will adjust your carry forward losses, you can definitely carry forward those losses and adjust those losses in the subsequent years. Definitely, but then there is a tax incidence which may come in subsequent year, which has to again get reported in the form number one. There is a specific table which is provided in form number one, wherein you have to give the reporting for the losses which are used for the purpose of VSV year and what is the impact, what is the tax incidence in the subsequent year. If those losses are anyway available to you in the subsequent year or anyway getting lapsed, then definitely there will not be any tax incidence on you. This calculation gets slightly tricky when you have various complications attached to it. Similarly, in the case of MAT credit, again, that is how it will work. If you have a MAT credit coming in from the earlier years and you want to use the MAT credit for the purpose of VSV year, then definitely the carry forward MAT credit will reduce. And the similar treatment, the way definitely something below the line and above the line, things will change. But similar treatment will be available in the case of MAT credit as well. Now, some things which are slightly unclear. As a taxpayer, when you have to go for VSV, what is the impact in the subsequent year? For the subsequent year, if you are required to pay the taxes, whether you will be required to pay the taxes along with the form number 3 or not, that is something which is not clear at this point of time, because as a taxpayer, if you go for the VSV, for the VSV year, you will be able to pay the taxes and you will be able to opt for the scheme. But if this particular VSV, you using of the earlier year losses, carry forward losses has an impact of the taxes and brings additional tax incidence on the subsequent years, are you really required to pay those taxes also to go to get an order from the commissioner? That is something which is not very clear in the scheme. Based on the earlier in the earlier year, practically I have not seen many cases where people have really opted for the cases where there is a tax incidence in the subsequent year and they are still opting for the VSP. Refund is something which is a bit complicated. If one looks at the way refund will work, in the case of refund, if something is due to you for the respective year, definitely that refund is something which you can use for the purpose of tax liabilities, and balance amount will be refundable to you without any interest consequences. Now, if you have any refund available to you in the any of the earlier or subsequent years, those refunds will not be available. There is a slight technicality which comes here. If you as a taxpayer is dealing with the refund and you also want to adjust, just a second. If as a taxpayer you have a refund for a particular year and you want to adjust those refund in the VSV year, that adjustment is specifically not allowed. Whereas the scheme always uses the word taxes paid against tax arrears. But from the earlier VSV experience, we have seen that any tax you paid for the respective year also gets covered. So there is a slight controversy, dilemma which comes in. But if you see the earlier cases wherein Bombay High Court in the case of Sunil Vaman Rao, Sakore, and Delhi High Court in the case of Genpact also had dealt with this issue very briefly, but they have allowed those kind of adjustments to the taxpayer because they have observed that this kind of denial of the refund for the subsequent or earlier years is something which is not very clear, but definitely that again opens a path to the litigation for the taxpayers. I think majority of these points we have covered. Coming to the various steps which are required for the purpose of availing VSV, we have 4 forms which we need to consider. Form 1 is something which kickstarts your VSV process. If you decide to go for the VSV, there are various information which are required to be filled in the form number 1 along with undertaking, wherein you are waiving your right to pursue any remedy available under Income Tax Act. So that is something which you are waiving your right, and you are giving that declaration to the government that you want to go for the VSP for the respective year. Few things to be considered while filing form number 1. The clear principle for the VSP 2.0, one order, one form. So if you have one assessment order, you have received partial favorable commissioner appeals order and for partial adjustments which are sustained by the CIT, you are in appeal before tribunal. For the partial relief which is given by the CIT, department is before the tribunal. Both the appeals you can settle in one form. But if you have two orders for one particular year, for the assessment, say just take an example for assessment year 1920, you have an initial original assessment order which is under section 143.3. Then you again receive a reassessment order under section 143.3 read with section 147. Then that for this particular year, you have two assessment orders which are in litigation at various stages. So you need to file two form 1 to close the litigation for 1 year. So one form will be for the original assessment order and one form will be for the reassessment order. That is how the filing of the form number 1 will go. Once the form number 1 is filed, designated authority has to issue a certificate determining the amount which is to be payable by the taxpayer. Time limit available with the designated authority is 15 days. Considering the workload of that the amount of the application which will be received by the designated authority, this may be a crunch situation, but definitely it will not impact the taxpayers. So 15 days where the amount will be determined. Again, there is no appellate remedy or something if you are not agreeing to the amount which is determined by the designated authority in form number 2, then there is no alternate remedy available to you in this case. Practically, in the case of VSP 1.0, when we worked on various clients, we have seen a situation where tax authorities have or designated authorities actually discussed beforehand before issuing form number 2, because they were very mindful of the fact that since there is no alternate remedy available and there was a clear intent on the part of the tax authorities also to close the litigations at the earliest, so they discussed beforehand the workings practically and they issued form 2 accordingly. Not sure how the authorities will dealt with these cases at this point of time, but yes, if you are not convinced with the amount which is reported in form number 2, there are very limited options available to you. You can still make a rectification application for which there is no specific provision in the scheme. So not technically, designated authority cannot revise form number 2 in any case. Again, once you receive form number 2, you get another 15 days to make the payment and withdraw all your pending appeals. Now, often in many cases, withdrawal of the appeal as per the form number 2, once the form number 2 is issued by the tax authorities, it is assumed, or rather all pending appeals are assumed to be withdrawn or deemed to be withdrawn. Along with form number 3, you have to withdraw the pending appeals officially. Often in the case of High Court, at times because of the various reasons, you may not be able to get the withdrawal order from the High Court before filing form number 3. So for that, it is very categorically clarified by the authorities that in case if you file the proof of withdrawal of the appeal, proof of your application of requesting for the withdrawal, even that will suffice for these purposes. And once you make the payment, you file form number 3. Along with that, then your department will issue, the designated authority will issue form number 4 indicating full and final settlement. One very good part of the scheme, it categorically specifies at various places any issue which is settled under VSV will not create a precedent value. It is something which will be available, or which will not something which will impact your pending litigation for the subsequent years. So definitely that is a concern for the majority of the taxpayers, which is taken care officially. And even in form number 4, there is a specific statement provided by the authorities that in such cases you will not be having any tax incidents or any precedent value, whatever issue you are going to settle in VSV. Few hygiene things which one should be very careful when you are filing form number 1. Email address is something definitely you will take generally you should report the email address which is available on the e-filing portal, because often if you use any other address, then it leads to various confusion at various stages. Sorry. Any incorrect reporting in form number 1 will definitely reject your application and the entire VSP scheme may go for a toss. Signature of MD or authorized signatory is required in the letter of undertaking. So practically, majority of the managing directors of many corporations keep traveling. So one has to be practically very mindful, especially when VSP last date is 31st, or rather, for the purpose of getting the lower tax incidence, the last date is 31st December. Considering the holidays in the last couple of weeks of the December, one has to be very mindful of this practical aspects while dealing with VSP scheme. This point number 2, we have categorically dealt with. What are the practical challenges we face? Again, I think point number 3, intimation of the payment by the declarant. We have discussed whether any tax incidents coming in the subsequent year on account of reduced losses or MAT credit, will something is not very clear. So one has to, that at least when I'm going to file form number 3, I will clear the tax liabilities for the year under VSP. But we have to see what is the reaction of the authorities when they are going to issue form number subsequent. When form 2 will definitely input the amount what they are demanding from the taxpayer. And proof of the withdrawal, something which we have discussed. Order of settlement. At this point of time, there is no specific time limit provided for the issue of the order of settlement. And definitely in some cases, since no time limit is prescribed, sometimes it creates some sort of an uncertainty. But since the intent of the government is clearly to reduce the litigation and to close the litigation, definitely we believe that on ground the responses will be a bit faster.
सर थोड़ा सा डिस्टर्ब करूंगा सर, थोड़ा सा स्क्रीन बड़ा हो सकता है क्या? लिटिल बिट.
Not sure. That is not something not in my control, because I think I have just made the full screen.
Okay, okay, sir. Please continue, sir. Sorry. Yeah.
I think quite a few points mentioned here I have already covered. Where if there is highest amount which is decided by the designated authority, how practically we should deal with it. For form number 3, practically we have seen often 15-day deadline is really insufficient at times. So it is always recommended that whenever you are submitting form number 15, form number 3, keep your majority of the things ready by the time you get the form number 2. And definitely, if you have any concerns on the form number 2 rectification request, something which can be evaluated, but as technically there is no window which is available to the tax authorities to issue any order for the rectification request, how they will deal with this is something which we'll be able to see once we practically start implementing this request with the tax authorities. And these are certain practical challenges which we always face with the tax authorities, wherein filing of the form number 1, designated authorities, decision on form number 2, which generally creates some sort of an authority, undertaking which is provided in form number 1, which clearly mentions that we agree to take not to take any further remedies against on these matters. So all these consequences is something which any taxpayer has to be mindful while deciding that. One clear embargo which comes in the case of pending litigation, specifically for transfer pricing cases. When you are dealing with the transfer pricing cases, and especially cases post assessment year 17-18, those are the cases. First of all, transfer pricing cases are always generally with a high demand and high adjustments. And again, there is an incidence of secondary adjustment, which is there on any transfer pricing adjustment which you agree to settle. There is no explanation provided in the FAQs, which is issued recently on 15th October. But yes, there was an explanation available in the earlier VSP scheme, wherein if as a taxpayer you want to settle any transfer pricing litigation, definitely secondary adjustment was something which was not done away with. One thing which we should be very mindful, in the earlier VSP scheme, the incidence of the secondary adjustment was not very significant because it was issued in 2020. At that point in time, secondary adjustment cases were not very much because it started from assessment year 17-18 onwards, 17-18 onwards only. So, but now the secondary adjustment is something which is a very critical factor for the taxpayer to decide whether he should go for the VSP for the transfer pricing cases. because though there are multiple options available to you, you have to get the remittance from the parent company, or you need to treat this as a deemed loan and offer the interest consequences on those deemed loan every year, or to close the everything you pay one time 18% as a tax incidence. So any adjustment happening over and above 1 crore will have a consequence of secondary adjustment, which takes, as a taxpayer, it takes tax incidence to as high as 43 to 48%. So definitely this is a bit detrimental, or rather very a step which actually restricts many multinational companies to go for VSV for the purpose of transfer pricing adjustments. But that is how the law is, something which we have to take it. But yes, that is something which is a very critical factor which one should be mindful when you are applying for the VSV for transfer pricing cases. Some practical practicality what you have to factor while going for VSV. Often when you evaluate the case, it is always a notion. At times, many cases we have practically seen with many clients, they are of the view that our cases are very strong, we don't need to go for the VSV. But it's always good to relook at the pending litigation when you are evaluating the VSV, because at times we see some cases are very old, some positions have got reversed recently, where it may not give you the required result in the litigation, and it may. Classic example is Section 36(1)(5)(a), wherein on account of the delayed payment of the pending of the employee's contribution to provident fund, there is a specific amendment last year which is retrospective, which clearly debar you from claiming any deduction. So if you have any such issues which are pending in litigation, it's worth settling those issues in litigation. It definitely you will be able to consider those cases only when you make a fresh evaluation for such cases. Often there are amount involved in some of the litigations is quite low, and in such cases it may not justify some high litigation cost. It's worthwhile to consider such cases for the purpose of VSV. Definitely it clears your balance sheet. If any company want to consider an investor proposal, then definitely it creates a lot of clearance in the balance sheet, that your balance sheet is slightly clear. This is more of a practicality. Often, and I've seen this case in a couple of clients where I've seen there is a definitely a good favorable order at the lower authorities, and often when you evaluate the order of the lower authorities, you have to be mindful of the fact whether lower authorities have actually considered each and every fact pattern while deciding the case. If that is not the case, there are very high probabilities when the case will be before the tribunal, such cases will be remanded back to the assessing officer. Because as a departmental representative, if I am a departmental representative, I want to get a disposal and I want to deal with any particular case in the litigation in the ITAT. The first thing which departmental representatives look in practically before the ITAT cases is whether lower authorities have considered all the facts and all the technical arguments while deciding the cases. If that is not the case, the first attempt which they will make practically in the courts, in the tribunals or in the courts, these cases should be remanded back to the lower authorities, because all the facts are not considered correctly. That is something which is an evaluation which is very important. Practically, I have seen many cases after 7 to 8 years of litigation reaching before the ITAT, and after dealing with the cases before ITAT, those cases have come back to the assessing officer. So if you are in such a situation, it's not only before that for the transfer pricing cases, it's also for all the corporate tax cases. If you are having any such cases, it's worth evaluating at this point of time. These are few technical, practical benefits available for the VSV scheme. Definitely, it avoids the protracted litigation, provides certainty from the financial perspective, savings of the litigation cost. Definitely, you have to weigh the litigation cost, because definitely when you go for the VSV, you definitely have some sort of a tax incidence. Interest and penalty will be waived for ever, but definitely one has to be mindful of the prosecution consequences which can come in under other laws. So just this is something which is a very careful evaluation which one has to do while evaluating to go for the VSV. Any MAT credit many MAT credit or carry forward losses which are lost, definitely if you use them, those can be beneficial as a taxpayer. Definitely caution points which you should have in your case that there is no option to go for the VSV partially. You have to go for entirety, or you can offer entire case or not to offer the entire case. But there is no window available to settle the litigation partially. Some cash flow and secondary adjustment is definitely is a key element for the purpose of VSV. Some points I've missed in the presentation. I'll just try to cover those points quickly. Which now suppose take an example. There is as a taxpayer you have faced two adjustment in the case of in a particular order. You have decided not to litigate for one particular adjustment, and you have litigated adjustment number 1 and not adjustment number 2. Now you want to go and settle the VSV appeal for the issue number 1. In that case, you have to pay taxes for definitely for both the adjustments, adjustment number 1 and adjustment number 2. But interest and penalty consequences will be waived only for issue number 1, which was litigated and which is closed in the VSV scheme. For issue number 2, interest and penalty consequences will still continue. So while evaluating, you have to also consider the cases where you have accepted the adjustments and you have decided not to litigate. Interest and penalty consequences in such cases will not be getting over. So that is one thing which as a taxpayer, you have to be very clear. Any case, any assessment order, if that kind of an assessment order, some high pitch assessment order is stayed by a high court or Supreme Court, those cases are not considered as a pending litigation for the purpose of VSV 2.0. It is very categorically clarified in the FAQs issued by the CBDT. Any cross objection which is filed by the department, or if you as a taxpayer who have filed a cross objection, that is considered cross objection before ITAT, that is considered as a pending appeal for the purpose of VSV. So you also factor all the cross objections filed by the department and you while going for the VSV. Needless to say, often after the receipt of the ITAT order, we end up in filing miscellaneous application to take care of any rectification issues which is arising from the ITAT order. Miscellaneous application, MAs are not covered for the purpose of VSV. It is not considered as an appeal for the purpose of VSV. So definitely you have to be careful when you're evaluating any pending litigation in these cases. Any case for which admission is pending before Supreme Court or before the High Court, those are the cases, irrespective of the pending admission, those are the cases which are still considered as a pending appeals, because the appeal is already filed, the process is pending before the High Court or Supreme Court for the purpose of admission. You will be definitely able to go for the VSV in such cases. Very recent, or rather I won't say very recent trend, the trend which is right now is very prominent with majority of the taxpayer. Nowadays, whenever you receive any reassessment notice under section 148A or 148, after receipt of the order under section 148A, the first thing which everyone evaluates is this is a case worth going for a writ petition or not. And often we end up in filing a writ petition because definitely if the case is something which is already covered by the original assessment, the stand of the department is weak for the purpose of reassessment, writ petition becomes a very clear way forward for the taxpayers to go for it. Though, if we remember, in the eligible cases, writ petitions are categorically covered. But in the case of reassessment, what happens? As a taxpayer, you don't have any tax liability which is recorded in the in your orders. So those cases are specifically excluded because the tax liability is yet to be determined. Those cases are specifically excluded for the purpose of VSV. Some consequential impact, especially when you are facing cases where department ends up in making couple of assessments for one issue. One is a substantive assessment and other is a protective assessment. Example, deemed dividend issued by company A to company B, and company A and company B has a common shareholder, company H. If the loan or any advance is given by company A to company B, potentially as per section 222E, it will be taxed as deemed dividend in the hands of the company B. But as per the court rulings, these kind of dividends are taxable in the hands of the shareholder. So what practically tax officer will do, he will either tax this income in the hands of company A on a substantive basis because he is someone who has received the income. On a protective basis, he will also make an assessment in the hands of company H. If company B, who has received the loans and in whose case substantive assessment has happened for the purpose of deemed dividend, goes for VSV, the appeal pending in the case of company H, which is protective assessment, that will be waived off. So that is something, an evaluation which one has to do when you have faced substantive assessment and a protective assessments. Now, often in the case of TDS, sometimes as a taxpayer, you face litigation on account of taxability of the income, and sometimes you face litigation on account of deduction of the taxes. If any case is settled under 201, this is something which is largely very relevant in the case of taxpayers, where you are largely dealing within the group companies. There is a pending litigation on 201 in case of one company, and there is a pending litigation in the case of foreign company on account of taxability of the income. That if any one company settles the litigation, consequential relief is available to the other company, be it under 201 or be it under 40A11. Needless to say, interest consequences on both the companies still prevail. Any writ petition or any appeal you file for the purpose of rejection of the registration under section 12AA is categorically not covered under the VSV scheme. Any interest waiver application filed under section 89 is categorically excluded for the purpose of VSV. Disputes under other taxes, other laws apart from Income Tax Act are specifically excluded from the VSV. And I think largely this covers all the setting issues in part is something which we have already covered. I think that's it. It covers stuff. So that's what generally we cover in VSV. Happy to take questions.
Yes, so participants, if you have any questions, you can ask on this portal. So one question has received.
Yeah.
The question is from the Chandradev Bhatt from UAE. He is asking, sir, if the assessing officer passed an order on 31st of May 24.
31st of May 24. Okay.
For an income escape assessment for an NRI.
Okay.
And the NRI filed an appeal with the Commissioner Income Tax Appeals before 30th of June 2024.
Correct.
So whether this case will be covered under Vivad se Vishwas? First question.
Yes.
Okay. And if he, as second question, he is asking in the same, if he is not covered, or if we don't want to go into the Vivad se Vishwas scheme, then what is the time limit for the CIT appeal to complete the appeal proceedings?
It's a question answer across India, because technically, as per the law, there is no time limit available to the commissioners for the disposal of the cases.
Yes.
And that's the reason precisely we are seeing there are many cases before the commissioner appeals which are pending from long time.
Yeah.
So to the question number one, definitely he can go for VSV. Question number two, at this point of time, there is no time limit available to the commissioner. But yes, practically there is a circulars which are issued by the CBDT wherein they have asked for the priority cases disposal. And there is a direction from the CBDT to dispose all the cases at the earliest. But practically how much that will be getting implemented on the ground, we have to see how it works.
Sir, what happening is, because of this faceless, many times the hearings did not came within the stipulated time period. It takes too long, 1 year, 2 year. These are long periods for the commissioner appeals. They are not passing the orders.
I completely agree with you, Mahesh, but that is the situation where we are. We have made some representation to the government. We have discussed these cases. In fact, this VSP scheme, if you remember, when the VSP scheme was issued,
Right.
Finance Minister categorically made a statement because of the huge pending litigation at the Commissioner Appeal level
Right.
introducing this scheme. So definitely they are also mindful of this particular issue which is happening, and they are also trying their best to do whatever best they can do. But that is what it is right now.
Yeah, okay. Sir, one question from
But
my side.
one practical point here.
Uh,
In some cases, or rather in many cases, we have what we have done for our clients. There is a specific email ID. I don't remember it right now, but if you send an email on that email ID giving your appeal details, this is what the appeal, and express the reason why you want an early hearing or disposal at the earliest,
Okay.
you end up in receiving the notices wherein at least they start taking the submissions.
Okay.
Practically on the ground, after taking the submissions, definitely we have not seen many disposals happening so quickly. But yes, at least the process starts.
Yeah, correct, sir.
Yeah.
Sir, one more question from my side on Vivad se Vishwas. Sir, you have said that if you are not agree, there are two issues in an assessment order, and you have appealed for both the issues. But now in the Vivad se Vishwas scheme, you want to settle one issue and you don't want to settle the other issue. So, while withdrawing the appeal, whether I have to mention for which issue I am the withdrawing the appeal and for which issue I am going under Vivad se Vishwas.
Mahesh, first of all, under Vivad se Vishwas, you don't have an option to do a partial settlement.
Okay.
Either you have to settle the entire appeal, or you cannot go for Vivad se Vishwas. There is no option available for the partial settlement. In
Okay.
fact, I also wrote an article on this tax sutra in when the VSP was announced. I
Okay.
also recommended the same thing, but there is a clear FAQ in the FAQs issued, which categorically denies partial settlement.
Okay. Full settlement.
You have to go for full settlement.
Okay. I think there are no more questions, sir. So thank you so much, sir. This was really a fantastic session, and all our participants have definitely benefited from this Vivad se Vishwas game. And any chances, sir, any chance you see that this date will be extended for the Vivad se Vishwas further? Because the deadline is near to that GST R9 and 9C and all that.
Yeah, but I think 31st December, likelihood of that date getting extended is very remote.
Okay.
But if you still see, they have not notified the end date in the case of Vivad se Vishwas.
Okay.
After 31st December, you will have an additional tax incidence of 10%.
Yeah.
That is something you have to go with. But the possibility of 31st December, in my personal view, is very remote. Definitely, once we will be in the month of December, there will be representations to the government to extend these timelines. But how they will react to it is something we cannot predict at this point of time.
Okay, sir. Thank you so much, sir, for giving your time for the from the CP committee. I sincerely thank you once again, and hopefully we will see you again in the next webinar. Thank you, sir. Thank you so much.
Thank you, Mahesh, and thank you to ICI and entire CP committee for giving this opportunity. Thank you very much.
Thank you.